video, I am going to share with you CapitaLand's latest announcement about their China strategy and what it means for investors. Let's get into it. Hey friends, welcome back to the channel. I am Iggy here, and I've been covering topics such as stocks, finance, CPF, and basically everything related to growing your wealth. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads. I've covered over 500 videos and over 250,000 watch hours as of September 2024. I also focus on topics related to regional and world economy. My fellow investors, let's dive into the latest buzz from CapitaLand Investments Investor Day presentation. The big news is that they're planning to significantly reduce their exposure to China from 27% to a mere 10-20% of their funds under management by 2028. Now, let's put this into perspective. CapitaLand currently manages a whopping $113 billion in funds, and they're aiming to grow this to $200 billion by 2028. This means they're looking at a massive restructuring of their China assets, which is a huge deal. The timing of this announcement is crucial, my friends. China's property market is currently experiencing a slump, with the real estate crisis making headlines for months. This has taken a toll on CapitaLand stock, which has fallen 12% this year, while Singapore's main stock index is actually up 16%. This restructuring move could be a strategic effort to mitigate risks and diversify their portfolio. I'll be keeping a close eye on this development, and I recommend you do too, as it may have implications for our investment strategies. After all, as investors, we need to stay alert and adapt to changing market conditions to make informed decisions. Now let's get to the nitty-gritty details, my friends. CapitaLand is being upfront about the potential risks involved in their restructuring plan. They're warning us that they might take a hit on their earnings in the short to medium term due to potential fair value or divestment losses. Essentially, they might have to sell some properties for less than what they paid for them. Ouch, that's gotta hurt. But here's the thing, they're not just sitting around twiddling their thumbs. They've got a plan to mitigate these losses and come out stronger on the other side. CapitaLand is aiming high, my friends. They want to more than double their operating earnings to over $1 billion by 2028-2030. That's a pretty ambitious target if you ask me. But they're not just relying on cutting their China exposure to get there. Oh no, they're on the hunt for new opportunities in other markets. Just recently, they announced plans to buy SC Capital Partners Group, which focuses on Japan. Now, I know what you're thinking. Japan, isn't that a mature market? Yes, it is. But that's exactly why I think CapitaLand is making a smart move here. They're diversifying their portfolio, spreading their risk, and tapping into new growth opportunities. And let me tell you, I'm excited to see how this all plays out. Now, let's dive deeper into CapitaLand's plans. They're not just stopping at reducing their China exposure. They're also exploring new opportunities to grow their business. They're considering listing new REITs in Australia, China, and India, which shows they're still committed to expanding their reach. And interestingly, they're not completely abandoning their China business. They're just shifting their strategy to use local capital to grow it. This makes sense given the current market conditions. Now, let's take a look at their track record with sales so far. They've done pretty well, selling $4.6 billion worth of assets up to early November this year. But here's the thing. Most of these sales came from Singapore and other countries like Japan, not China. They had aimed to sell about $1 billion worth of assets in China this year, but they've only managed about $300 million so far. That's a pretty big gap. Looking ahead, they plan to sell about $3.5 billion worth of Chinese assets over the next 3 years, but they're going to stop giving specific divestment targets next year. This suggests they want more flexibility in how they handle these sales, which makes sense given the unpredictable market conditions. I'll be keeping a close eye on how this all plays out, that's for sure. So, what does all this mean for investors like us, my friends? Well, first and foremost, we can expect some volatility in CapitaLand's stock price as they start executing this new strategy. They're making some big changes, and that always leads to some short-term uncertainty. But as investors, we need to keep our eyes on the long-term prize, right? Second, We should be on the lookout for new opportunities in other markets where CapitaLand is expanding. They're diversifying their portfolio, and that could lead to some exciting new developments. And third, we need to keep a close eye on their progress in divesting their China assets. That could have a significant impact on their earnings in the coming years, so we want to stay on top of that. Now, if you enjoyed this video and want to dive even deeper into the world of REITs, I've got a treat for you. My video on Singapore REITs, hidden gems in the property market, is a must-watch. In that video, I break down the best performing REITs and share my top tips on how to spot undervalued opportunities in our local market. I'll show you how to navigate the world of REITs with confidence and make informed investment decisions. Trust me, my friends, you won't want to miss it. My video on